The broadcast is now starting. All attendees are in listen-only mode.
Hi, everybody. This is Monica Main, and welcome back to our flipping series that we have for our mentorship group. So welcome back to Flip It Profit, segment number 2. And thank you so much for being part of this group. I have to say that, first of all, I don't know that I've actually outlined exactly what we're going to be doing as far as the curriculum for the entire 8 modules here. So I wanted to just kind of give you a clear idea of what to expect between now and the rest of the modules that you'll be looking at, so that you'll have some idea as far as what to expect in the modules to come. So in the last module, we went over the brief overview of the business. And what we're also going to be doing is, this is kind of part 2 of the overview. In the next 2 segments after that, we're going to be talking about how to profit from the actual professional fees portion. So in other words, being a bird dog or a property scout, to get bird dog or property scout referral fees on the deals that you find. So we're going to be talking about that in the next 2 segments. And then the final 2 segments are going to talk about actually flipping property. So in this second segment, we're still on the overview portion of this. And the reason I'm doing it this way is because I want to ease you into the business, but mostly I want you to understand the overview or the bigger picture of exactly what we're going to be doing, so that you understand what you need to ultimately be focused on as your overall bigger picture when you're getting involved in this business. And so it's just not a matter of doing some kind of get rich quick type of deal where you're going to be in this business and out of this business in, a couple of months. At least that's not what I'm hoping for you. I'm hoping that you actually find this as a long-term income source, initially to be an aggressive income source, and then ultimately to become a passive income source. So I want you to be able to ultimately build a massive real estate empire, or even just a small real estate empire where you just have maybe a handful of properties that are giving you passive income every single month, that can ultimately allow you to secure the financial freedom that you've probably been looking for many, many years. And so again, this is why we are continuing on with this overview, so that you don't lose sight of the bigger picture before we start getting into the nitty-gritty on exactly how to work the business from the aggressive side, and then ultimately working into the flipping side. So the aggressive side meaning the property scout portion of it, and then ultimately getting involved in the flipping side, and then finally getting involved in the passive income side. So that's what we're continuing on doing for this segment. And like I said, the next 2 segments, we're going to be really hyper focused on the bird dogging side of the business. So let us get started. So as we had kind of let off last week, I was asking you to sort of start getting an idea of where you see yourself investing in passive income assets somewhere in the country, and it may or may not be in your own backyard. In fact, likelihood of it being in your own backyard is probably next to 0, unless you happen to be in one of the top areas of the country that you can actually make a really good cash flow. And so, like, for example, I live in LA County, and to be able to get a buy and hold asset here in LA is relatively difficult to do unless you're putting 50% cash down. And even then, it's really not worth it, because I know a lot of my investor cohorts that I'm working with now that have a lot of property here in California, they're starting to complain about the ridiculous amount of brand new requirements for building codes. And then they're really, really getting sick and tired of the brand new tenants' rights laws that are coming into play, which are kind of inhibiting property owners to be able to get rid of deadbeat tenants quickly. And so it's becoming very difficult to do business in California as a real estate investor. And so if you're in California, you definitely have to find a different place to get buy and hold assets, because ultimately you're going to find that you're going to be investing on a sinking ship, if you will, if you get started here in California. So, those are things that you need to be kind of aware of. Where are you going to be investing when you're starting the process of getting your own duplexes, triplexes, quads, or small apartment buildings for buy and hold purposes? And so I need you to not solely focus on that, but I do need you to have that question in the back of your mind as you begin this business. Where am I ultimately going to be investing? What's the single city in the United States that I'm going to be investing in buy and hold passive income, multifamily, and small apartment building properties? So you don't have to run out and figure it out today. I've gotten a lot of emails from students asking, well, I know you want me to figure out where to invest, and I'm kind of confused because I don't really know where to start. You don't have to figure it out today, okay? It's not like you have to figure it out right at this moment, but you do need to keep your eye focused on the bigger picture, which is why I bring it up, is that the bigger picture is very, very important. Because I will tell you, having gotten started as a flipper in 1995, I wish I would have known that passive income real estate was the key to financial freedom forever. And nobody really told me that. I had to bumble in it myself, and that's why I'm passing this critical information on to you so that you don't have to go your entire life just to figure out that flipping is not the end game. The end game is getting passive income real estate for yourself to get that passive income coming in. So the every other strategy, I kind of talked about a little bit of this last time, and I want you to just take a look at this. This is kind of an overview. So the basic premise is that you'll flip a property for cash, and of course this also goes with being a bird dog as well. It's just that you'll need to do a lot more than just one property flip to be able to get enough money to be able to buy a single family property for a buy and hold investment. But if you are doing a flip, you could do something called the 1031 exchange, which is an IRS tax code that allows you to buy a property of the same equal value or greater value within the next 6 months. And by the way, tax codes do change all the time, so please do get with your CPA on this before you do this particular strategy. But as of right now, it's within 6 months you do have to buy a property of equal or greater value within 6 months to be able to defer the taxes. And so essentially what happens is, say for example, you purchase a house and you purchase it for 100 grand and you put another 50,000 in upgrades and rehab and so forth. So you're in at 150,000. And just for simplicity purposes, we're not going to talk about fees and all that other good stuff because there are going to be fees in all of these transactions that you do. So say for example, you turn around and you flip this property. So you're in it for 150,000. Say you flip it for 250. And so you make a profit of $100,000. Well, if you use the power of the 1031 exchange, then you could basically not have to pay capital gains on that 100,000, because normally what you'd have to do is pay taxes on the 100,000 at either the level of which you have your corporation, whatever tax level that is. If you're a C corporation, you're going to have to pay taxes on it. Or if you have an S corporation, or you're doing this under your own person, which I don't recommend you do. I recommend you do get a business going to be able to work your business, which I'm going to talk about shortly. You still have to pay capital gains taxes, which is typically whatever percentage you have to pay at your personal income tax bracket, which really sucks for most of us because most of us are at a 50% tax bracket, unless you or like Donald Trump, where you don't really pay a lot of taxes at all. Otherwise, the average common man and woman at the middle class level, or even the upper middle class level, has to pay the vast majority of the taxes in this country. And so you want to start looking at how you can beat the system, if you will, legally, and be able to get around paying a lot of these taxes unnecessarily, so that you can continue to build your wealth. And this is one of the ways that the rich do it, is that they use the 1031 exchange. So you basically take that $100,000 and within 6 months you can buy a property of equal or greater value using part of that money. You can even use it as a $100,000 down payment on, say, a small apartment building to be able to qualify for the 1031 exchange. So again, please get with your CPA before you do any of this stuff, because these tax laws change all the time and there's always a lot of ins and outs. And so I'm just giving you the basic broad overview of it, but I'm not really a tax person, so you do need to get with someone who knows more about it. But that's in a nutshell how it works. And so ideally, your investment property will be one that is 100% cashed out from the flipping proceeds. So for example, say for example you take that $100,000 and it's now you get another property. Say for example you even put 75% down or 50% down, and the other 50% you get a mortgage. I'd like to see you actually use that money to be able to get a property free and clear. However, if you're getting a small apartment building, then you can get something called a commercial loan for residential commercial properties. If it's a property of 5 units or more, if it's an apartment building of 5 units or more, that falls under the commercial loan category. And you can use that $100,000 for massive leverage. because you can use that as a 20% down payment on a property that's 500,000 or or more. So that is the best way of doing it. I'd like to see you start getting involved in small apartment buildings, and then therefore you could use the leverage of OPM or other people's money through mortgages, which is the smart way of doing it if you're getting involved in these types of multifamily assets. However, if you're going to be sticking with just doing single family residences, then you want to be able to set it up to where you can actually pay cash for those properties. So when you collect your buy and hold single family residences, or even your small duplexes, triplexes, or quads, you keep collecting these as buy and hold assets until you reach your financial freedom point, which, if you recall, last time we talked about your financial freedom point being the amount of money that you need to be able to adequately support yourself by today's standards. So that means today's cable bill, today's car payment, today's insurance payments, today's mortgage, whatever it is that you collectively have to pay today to be able to cover all of your expenses comfortably. And I'm not meaning cut anything out. I'm not meaning diminish anything. I'm just meaning as is today to live a comfortable life. What do you need to see coming in every month? And that is what I call your financial freedom point. So once you meet that, then technically you could retire, or you could just maybe double or triple your financial freedom point to ultimately be able to feed more of that money into other passive income real estate transactions. And so that's ideally what I like to see you do. And so you can now get bigger and bigger buildings, ultimately require financing if you do have decent personal credit, which I believe we started talking about that last time. And we discussed that I'd like to see you at a mid FICO of about 720. Interesting story, by the way. I should mention this because I like to give a lot of my students a lot of the personal stuff that's going on in my life. And recently I actually experienced about a 65-point FICO drop in my personal credit score. I've been in the 800s for many, many years. In fact, one of my FICO scores was actually 850. And then all of a sudden I got a recent ding. So I pulled my credit the other day, and I found that there was obviously no late accounts because I was afraid that there was some kind of identity theft situation. I had already dealt with that in the late 90s. I didn't want to go through that again. So I was immediately concerned about that. So I pulled my latest credit report through Experian.com. This is in fact the place I recommend everybody go get their credit report, is Experian.com, which is one of the 3 credit bureaus. And I actually pulled my credit, and this time I made sure, because I had a situation with my daughter where her Social Security number was compromised, and somebody else filed taxes using her Social Security number to be able to get the child tax credit. And so it really kind of put a tailspin in my whole IRS filing this year. And I had to file an identity theft form and all this other stuff. I actually had to prove that my daughter was in fact my daughter, including a copy of her passport. She happens to be a unique individual where she actually has a California state ID, which came in handy because I knew it was going to come in handy at some point, because it actually had her address on there, which is what they wanted to do, was to be able to prove that she lived at my address with me. And so what's interesting about the IRS, and what my biggest qualm with them is that I've been filing using my daughter's Social Security number since she's my child on my taxes since the 2008 tax year, or when I filed in the spring of 2009 for the 2008 tax year. But yet never at any given time did they ever stop the person who's then decided to file using her identity. They never asked for that person's proof that my daughter was in fact belonging to them. They come back to me and ask me to prove that my daughter in fact belongs to me and that I have the right to file using her information. And so I just don't understand the IRS. I think it's just a completely discombobulated, screwed up system, and identity theft is everywhere. So I started to backtrack thinking, where did this identity theft come from? There's only one way it could have happened where somebody stole my daughter's identity, and it was through the healthcare system. It was either through her doctor's office, or it was through one of the 2 health insurance companies I had gone through, either Health Net or Blue Shield. I don't know which one it would have been. And so it did actually happen through the healthcare system in some way. So the fraudsters, they're everywhere, and they're out there to steal your information. So I strongly advise you. Now, this is not something I would have advised you years ago, but because I had personally been hit with a data breach this year, And a few years ago, on top of that, I not only have LifeLock, which allows me to monitor all of my stuff that's going on, but the biggest reason that I have LifeLock is for that $1 million insurance policy in the event that somebody does in fact compromise my entire identity. And now I just signed up for Experience. I think it's some $25 a month program that they have to not only allow me to pull my credit and look at it all the time, but to also help monitor and get rid of any kind of possible fraud potential exposure that I have, because now I know I'm exposed. And so I strongly suggest you do the same thing. Again, this is not something I would have even advised a few years ago, but because there's so many data breaches, I was part of the Experian data breach a few years back. I was also part of the last IRS data breach a few years back. And then now I've been part of yet another data breach that happened this year, in addition to the data breach that happened in for my daughter's information through the healthcare system, which is probably one that you won't see on the news, unfortunately. So I strongly recommend that you do highly consider getting one of those monitoring services, because, this is your identity we're talking about, and you're going to be spending a long time, especially if you have bad credit now, but you're going to be spending a lot of elbow grease trying to fix your credit, like I did, because I filed for bankruptcy back in 2003. So I worked my ass off to get my credit to where it is now. And so I strongly recommend that you do have a monitoring system in place of some kind now, because there's so many breaches that happen all the time that you need to protect yourself, and it takes way too long to fix your credit to have it be swallowed overnight. So anyway, that's why I pulled my credit, just to realize that there was not a breach. Thank God nobody stole my social security number or started to, open up fraudulent accounts, which I'm pretty sure I would have found out because I do have LifeLock. But I wanted to make sure. And so I wanted to share with you what I discovered and why there was a huge dip in my FICO score. It was because of me. I was paying off a Disney cruise, and Disney, I have a Disney Visa card. They don't give me a lot of money on that card, and I barely ever use it ever. And so they only gave me a $3,500 limit. This was years and years ago, and they've never increased it since. And so I booked a Disney cruise for my daughter and myself this summer, and I decided I wanted some Disney points by by paying for part of the cruise on the card for the maximum amount that I could pay for the cruise on the card, which, as I just mentioned, is $3,500. That's all I could pay. These cruises typically are $6,000, $7,000, $8,000, depending on how long the cruise is. And so I used the most I could use on this Disney card to pay off the remaining balance of the Disney cruise to be able to get those Disney points. Well, that was a mistake, because what happened was that it showed that I maxed out that card at 99%. And so that actually dinged my credit, which is going to take me probably about 2 or 3 months to get it back up. And so I wanted to share this with you, because when you have credit cards, you do need to make sure that you're below 50%. I like to see people at 45%. Some of the credit bureaus like to see you at 35% or below. So in other words, if you have a credit card, say a Visa, Capital One Visa, for example, or actually that would be MasterCard. So say you have a Capital One MasterCard, and they gave you $10,000 unsecured credit. Well, I don't want to see you at any given time ever have that over $3,500 charged up on that card. And the reason being is because, some experts have said 4,500. Did I say 35,000? 3,500. You don't want to be over 35%. And some experts say 45%, but I believe they've changed the algorithms ever so slightly just in the past few months, to whereas if you're spending more than 35% on any given card and you have the balance that stays at 35% or higher, that will actually affect your FICO score, and your FICO score will begin to go down. So if you have maxed out credit cards, that's one of the reasons why your FICO score is so low. So here's a suggestion for you. Pay down those cards as quickly as possible. Find some debt consolidation service if you can, and then never charge up those credit cards beyond the 35% balance, maximum 45%. That would be max. And so I thought over the years it was across the board, meaning that if I had a total access of $100,000 in credit among, say 10 credit cards, that they were going to take the overall balance. And that's not the case. They recently changed their algorithms to whereas it's actually on every individual card now. So every individual credit card will show that you're maxed out if you, say, for example, only use one card. Like, for example, personally, I only use my Capital One Venture card for my personal purchases. Well, that's a mistake, because even though I have a bunch of credit cards personally, I only use that one card, which means that it looks like I max it out all the time. Same with the Disney card that I just explained to you. I basically never use that card except for Disney parks or when I'm at Disneyland. But whenever I max it out or use a bunch of money on that $3,500 low limit card, guess what? It looks like I'm maxing out that card all the time, and it dings my FICO score. So my FICO actually dropped 65 points over the last couple of months because of this stupid Disney card and because of this stupid cruise. And I thought I was doing myself a favor by getting all these Disney points by actually paying for the remaining balance of the cruise on this card. Well, I actually made a mistake. And so now I'm paying the price for it on my FICO score. Now, the good news for me is that my FICO is way up there anyway. It's still like in the 750s and high 700s with one of my credit reports. But still, it bothered me because I worked so hard and I've had it in the 800s for so long that I'm just like, what the hell? So they recently, I just want to let you know, they recently did change their algorithms again, and you don't want to max out any given single credit card. So if you have, say, 3 or 4 credit cards, try to evenly use all 3 or 4 credit cards. Even better, when you can actually get yourself some business credit cards that don't report on your personal credit bureau reports. Like, for example, I have a ton of American Express cards for business that I actually got through my businesses, through the business EIN. And even though they need my personal social security number to be able to access my personal credit to take a look at my credit worthiness, I use a lot of my American Express cards for the business. I don't even use my personal Amex card. I always use the business Amex card to alleviate the pressure on my personal FICO because I don't want to even use any of my personal credit cards anymore. So you don't want to close the personal credit cards because that will also ding your credit. But you don't want to use your personal credit cards as much as you use your business credit because your business credit's not reported on your personal credit reports. The only credit card company that personally reports, that will report the credit stuff that you're doing is Capital One. I have a Capital One Sparks card and I absolutely hate it because they do actually throw all that on my personal credit. But my business American Express throws nothing on my personal credit. None of the other business credit card companies I do business with, including Bank of America and US Bank and Citibank, put any of the business activity on my personal credit report. The only one that does that is the Capital One Sparks card. So I absolutely hate that card. And so if you're going to do a business credit card, do not, I repeat, do not get a Capital One Sparks card. Work with American Express. I think Discover Business also has an issue putting stuff on your personal credit report, so don't get the Discover Business credit card either. But focus on getting Citibank credit cards, especially the one that you get when you go to Costco. You can get that business credit card. Get the American Express business credit cards like the Delta. I love the Delta card. They have a Plum card. I have pretty much every single card you can get from American Express on the business side. You can also get a business Bank of America card if you have a Bank of America business account, which ultimately you're going to have a business account for the money that you're making for your business here. So these are all things you need to start thinking about. So please know that, yes, I screwed up and I made a mistake. Well, it wasn't really a screw up. It's the fact that I wasn't paying attention and the credit bureaus changed their algorithms and how they calculate your FICO score. And so, of course, I've paid off the Disney card already. However, it's going to take a little bit of time for that to, float back up. It's almost like a balloon. It's just going to take a little while to kind of automatically float up on its own, and it usually takes about 2 to 3 months to do that by itself. But please, word to the wise, you don't want to keep those business or those personal balances up on those credit cards and those loans and stuff, because that will pull down your FICO, and you need your FICO if you're going to be getting unsecured credit for flipping in particular. You need your FICO to be up there. So I want to talk about your basic business setup in this business. This is all very, very important stuff. You want an S corporation in your home state. So how it's going to work is that you're going to go online to find a company that can form a business corporation for you. I just did a new one yesterday. I like to use the company called AmeriLawyer.com. It's A-M-E-I, Amera, like almost like half of America, Amera, and then the word lawyer.com, AmeriLawyer.com. They don't do all 50 states, though. They only do a handful of states. Like I think they do California, Arizona, Nevada, Illinois, Georgia, Florida, I think Delaware, and I believe those are the only ones they do. I think there's a couple I'm missing in there. But if they don't do your state, then you can go to LegalZoom.com or many other corporation formation services that can help you out there. But you do need to be in your home state. So for example, if you live in California and you're bulking at the $800 a year that you got to pay for the filing fee every year to the Board of Equalization, no, the Franchise Tax Board, and you're balking at that, just understand that that's part of the business world, and that's what you need to do. I know it can be very enticing to go across the border and get a Nevada corporation, but I do have to tell you, there is a slight possibility, it's not a large possibility, but there is a slight possibility that you could at some point in time get in trouble for the violation of interstate commerce. And you don't want to do that. You don't want to have a business in Nevada, but knowing damn well you're doing business in the state of California, that's actually considered illegal. So I do have to tell you that. I know the temptation is there because the state of California has such high annual fees every year to renew the corporation. But I think this is the only state that rips everybody off in that way. I know my Michigan corporation is some ridiculous sum of money. It's like somewhere between $25 and $50 a year for those, because I have LLCs there for the properties I have. And same with the other states that I do business in. It's like nowhere near the cost to keep up a corporation here in California. So you want it to be in your home state just to be able to make sure that nobody can ever pierce the corporate veil. There's always a risk that someone can pierce the corporate veil by calling it what my lawyer used to refer to it as an alter ego, meaning that somebody would maybe incorporate a name and they would be functioning under that name, but it wouldn't really be a quote unquote serious corporation. It's just something that he or she is doing just to make it look like they have a business, but really they don't. You don't ever want to be accused of that, because that's how people can file a lawsuit and ultimately pierce the corporate veil and get to your personal assets. You don't want that to ever happen. And so we always want to be as compliant as possible, especially in regard to your corporation. So make sure it's a corporation in your home state. Now, you don't want an LLC. The LLCs are only for your real estate acquisitions. And by acquisitions, I mean the ones you're holding on to, not the ones you're going to be flipping or reselling. So the LLCs are only for your real estate transactions of your buy and hold assets, and your LLC will be formed in the state in which your property is being purchased. So for example, you might be living in California with me, so you have a California corporation, but then maybe you're interested in buying properties in Atlanta, Georgia. So then you'd have an LLC set up for your properties, and for a Georgia LLC set up for your property purchase in Georgia. And so that's typically how that works. So you want to start off with an S corporation in your home state using one of the services I outlined. And every corporation starts off as a C corporation. I always joke with people and I say it's born a C corporation. However, you do have to change it from a C corp to an S corp, because you don't want to be falling under the double taxation laws. A C corporation is taxed at the profit level of the corporation, and then again it's taxed on your personal level with all the profits left over. You don't want to deal with double taxation. So what you do is, when you get your corporate resolution paperwork in the mail from the corporate resolution company, you just simply go to the irs.gov website. You first have to get an EIN number, which is the Social Security number equivalent for your corporation. This is what gives it life, in my definition anyway. And then immediately, once you get your EIN, you can then immediately file Form 2553 at the same irs.gov website. So you go to irs.gov, you first get your employer identification number. The easiest way to do it is to go to the IRS search bar and type in EIN online, and then you'll immediately get to the page that will give you a guided, it's almost like a guided tour in which to get you the Social Security or the EIN for your company. Make sure you're connected to a printer. Have a laptop or a desktop that you're connected to your printer. You will have to print out the EIN information to take it to your bank to ultimately open up your business bank account. If you do not have a printer, at least save it as a PDF file to print it later, because the bank cannot open up your corporate account without that EIN number. And it typically takes the IRS 6 to 8 weeks to get around to actually mailing you the information, and that's way too long. So you do want to be connected to a printer, or at least save it as a PDF file until you can print it out later, because you will need it for your bank account. And so once you get your EIN number, you stay in the irs.gov website, you type in Form 2553 in their search bar, it will take you directly to the form. But this is a little tricky. You can't file this online, at least I don't think you can as effective today. That might have changed. But you literally have to print out the form after you fill it out, and you have to either mail it to them or you have to fax it to them. Yes, they actually still do take faxes. And this basically changes it from a C Corp to an S Corp. And in about 6 to 8 weeks, they will mail you a nice little letter that says, not congratulations, but essentially that you have been deemed an S Corporation. Make sure you save that paperwork in the event that there's ever an issue. because this will allow you to now file taxes with the 1120S form. That's 1120 S as in Sam, which will be your annual filing that you have to do. Please note, all S corporations and all LLCs do end on their tax year ends on December 31st. C corporations are the only type of corporation that you can actually change the end date, so it would be the last date of any given month in a year. But an S corporation and LLC always ends on December 31st, which means you do have to file your tax return March 15th. I remember when I first got started in business, I thought, oh, this is I have plenty of time to file my corporate taxes because I have April 15th that's the deadline. It's like, nope, March 15th is your deadline to file your S corporation tax returns with the 1120S form. And it's fairly easy to get TurboTax or one of those ones that actually allows you to do corporate returns, and you can do it yourself for the first few years until you actually have enough money coming in to where you should get a CPA or somebody else to do it for you. So it's not that hard to do. I've just given you all the steps that I wish somebody would have told me about when I first got started in this business, because nobody told me how to do any of this stuff. I didn't know any of it. So I'm telling you so that you're fully prepared in how this whole business needs to unfold. Now you do need to get an S corporation regardless of if you're getting finder's fees as a bird dog or if you're going to be a property flipper. Either way, I want to see you with an S corporation. And then finally, well, not finally, but you will be getting a business bank account. So once you get your corporate resolution paperwork and your EIN number, you take both of those things down to your local bank. I recommend you use Bank of America unless you prefer a different bank, because Bank of America offers so many different loan programs, unsecured credit card programs with deferred payments for 7 to 9 months. They have all kinds of stuff that they're all offering. In fact, I just had my banker call my cell phone the other day, and he was saying, you know, Doris is my normal lady, but this other guy, his name is Charlie, and he's like, you know, I'm part of this higher department now, and I'm looking at your bank balances, and they're so high that I want to offer you all these things. I mean, it's amazing what people want to offer you when you have a ton of money in the bank. And so he's trying to offer me all these different programs, and I told him I'd get to him later because I was busy, but you know, Bank of America is notorious for throwing everything at you once you can establish yourself as a legitimate business owner who's, you know, making some bucks. And that's exactly what happens to me constantly. I'm constantly being notified in the mail or on the phone or in some way, shape, or form about all this money that they're trying to offer to me, whether it's an unsecured loan, a business loan, et cetera, et cetera. And so that's one of the reasons why I like Bank of America so much, is because of that. So you'll get a business bank account, and again, all you need is your corporate resolution paperwork and your EIN number that you printed out on your printer. And then you have a business bank account. You probably should first get yourself a business phone number before you start doing that. That could be an extra cell phone number. It could be a Vonage phone number. It doesn't matter. So then that way when you go to the bank, you actually have a phone number, a business phone number to give to them as well. It's up to you if you want a business address. For now, you know, you might want to just use your home address. But I do recommend at least getting a UPS store address if you can't get like a virtual office, just so that you could show some legitimacy, but it also helps you build business credit a lot faster. So a word about personal credit. They consider good or decent middle range credit about 680 or above. So if you have a 680 FICO with no bankruptcies and no foreclosures, you could still get a low interest rate mortgage on an apartment building. But I like to see your FICO higher. I like to see it at between 720 and 750. And in my book, that's what's considered really good credit. So if you want to have access to higher dollar amount business lines of credit or mortgages, or to be able to just never worry about qualifying for credit again, then you need to be somewhere between 720 and 750 as your mid FICO score. Banks are still strict even after the 2008 debacle. They're strict on all kinds of loan programs and stuff, but they still have remained strict on commercial mortgages as well as residential mortgages, just because of what happened in 2008. They don't want to see a replay in that, so they're not really allowing for the same types of loans that they used to do. Now, lenders might. You might have a mom and pop lender that is willing to take that risk, but most of your bigger banks are simply not willing to do that. So while you're setting up your business, and even if you start off as a property scout, for example, you still have plenty of time to start fixing your personal credit so that you could participate in other opportunities as we go down the road, including flipping, including buying an apartment building using a commercial mortgage and so forth. So I just wouldn't wait too long. I would not throw this on the back burner because you're thinking I don't need it today, but you should start working on it now, which of course will start with you pulling your Experian credit report and starting the process of disputing all the adverse marks in there, just to be able to start the process of fighting for your credit, all the while opening up, at least 1 or 2 new credit cards and making good on your credit card payments. From this day forward, you are to make good on all of your loans, make good on all of your credit that you have. Start paying your bills on time, because it's going to pay off as the months roll on, whereas you'll have access to all of these lines of credit to be able to use other people's money to have maximum leverage in your real estate business. So I have a very specific strategy that you can use to be able to further yourself in this business a lot faster. And so you understand kind of how the business works, at least the overview anyway, starting from backwards, which is to find passive income assets ultimately is your end goal. And then you also know that there's a couple of ways that you can start the process of becoming part of this business, whether it's as a full-time property scout or part-time property scout for referral fees, or you can actually become a flipper, or you can do both. And then ultimately, just to start off in the business, you should use some of those proceeds to ultimately put into passive income assets, whether they're small houses that you can cash out 100% or as down payment money to buy a small apartment building in your real estate empire area. And so here's some quick ground rules. To start off with, I only want to see you work with single family residences. Now, it might just be your first property, or it might be your first 2 or 3 properties. But right now, I don't want you to really focus in on the bigger properties at this point, unless you've been one of my students for a long time and you kind of have the hang of the single family residences, or you at least have bought a couple of properties already. If you've never bought one single property for the purpose of investment, then I'd like to see you work with a single family residence. The reason being is because most people psychologically start talking themselves out of doing this when it seems like the business is too big and over their heads. So they might be like, well, I don't know about that 4-plex. That just seems like a lot of work. There's too many units. Or I don't know about that 6-unit apartment building. I mean, I've never done that before, so I don't know. Maybe I should just not do it at all. But everybody can kind of associate with, and at least has at least some experience level with single family homes. I don't even care if you've never owned a single family home. I can guarantee you that you've known somebody who has purchased a property. I can guarantee that you've lived in a property. So it's not too big of a psychological obstacle to ultimately talk yourself out of if you're working with something that seems doable and reasonable for you to do. That's one of the biggest reasons as to why I'd like to see you start off with single family properties. And if it's just being a property scout or bird dog, that's fine. Start off with single family homes. Or if you're working as a property flipper, especially, I want to see you working with single family homes. And so every other deal can either be a short sale flip or a fixer-upper flip, or it could even be a foreclosure flip. And then if you can get still bank-owned properties, there's a lot of bank-owned properties now coming onto the market. And every single time I know a market's about to go underwater, is I'll take a look at my immediate area. I live in an upper middle class area. And when I start to notice the foreclosures coming onto the market, I know the economy is starting to shift. There are areas of the country that what we call the forerunner areas. The biggest forerunner in the state of California, believe it or not, is the Bay Area. That's the San Francisco area. The second forerunner area in California is Los Angeles, the greater Los Angeles area. And so what I do is I look at those 2 areas to see what's happening, because typically what happens is, because the state of California is actually the 8th largest economy in the entire world, we actually tend to have the major trends here that actually end up domino affecting across the country. And so I've noticed that the market's been getting kind of cold for the last 18 to 24 months now. And it's really now becoming stone cold within the last 6 months, when I'm now starting to find that there's a lot of foreclosures coming in on the market. There's a lot of short sales now coming on the market. These are things, by the way, that almost ceased to exist up until just a couple of years ago, and now they're coming onto the market with greater frequency. The other indicator is that when people have a property that's up for sale, and it's up for sale for a longer than normal period of time, houses around here usually typically sell within about 2 weeks or less. Now, when you're starting to notice properties sitting on the market for months, that's when you notice that there's an economy shift that's happening. And so the bank-owned properties are still coming on the market with greater frequency, which also indicates a major shift coming up. My favorite, though, isn't really working with REOs. It's actually working with properties that are older. They're typically 20 or older. Around here, it'd be 30 or 40 years old. And actually going door to door. I usually hire someone that can go door to door with oversized postcards, and they can actually drop the postcard at everybody's welcome mat by their front door. And you're looking for people that want to sell the property. They don't want to deal with a real estate agent. They'd like to save their money that way. And you can do a very quick, property purchase that way. It would be slightly below market value, but you'd be able to pay them 100% cash and guarantee a very quick close within about 2 weeks. And so I'm going to be talking a little later about my money source that will allow you to do that type of deal. And so the property sale types that I want you to, I guess, understand. The first one is bank-owned properties. REO stands for real estate owned, which are foreclosures. You could find them online through a wholesaler. So typically what a wholesaler will do is they will have an in with a bank, usually a small to medium-sized bank, either the loss mitigation or asset management department, depending on whether it's a residential or a commercial property. And what they'll do is they'll buy anywhere from 50 to 100 or maybe 200 properties at a time under one transaction. And so the wholesaler will then turn around and individually sell each property to an investor or a flipper. And so what I like about dealing with wholesalers is that you don't have to deal with the bank. Typically, there's no closing, there's no appraisal, there's none of that stuff. You just go to them. Many of the times they could help you finance the property because they have their own in-house financing program. They'll be able to allow you to have access to the property with very little money down. And they will actually transfer the title of the property to you through a quitclaim deed rather than going through the entire escrow process, which is costly and time consuming. And so I love dealing with wholesalers. You can actually find them online. There's a ton of them. If you're not sure, I would go to a website like loopnet.com, and I would actually start to look at boarded up properties that are still listed there from even years ago. And you can many times find wholesalers that have a ton of other properties. Usually these wholesale lists will appear as a Excel spreadsheet. And so many times you just have to contact them and they can send you an Excel spreadsheet of all the properties that they have available. Sometimes it's just a single family home asset list, and other times it has a combo of single family properties and some small duplexes, triplexes, and quads in there, which are really, really good to get. You could also hook up with a kick-ass listing agent, which would ideally work with a small bank or a medium-sized bank, the loss mitigation, which is the department that handles single-family resident foreclosures. The asset management department would be working on behalf of a commercial bank on the commercial foreclosures. So usually what happens is that when a bank wants to start unloading these properties, what they'll do is they'll connect with an agent, a listing agent that can work on behalf of the bank, usually under their own small brokerage firm or even a larger brokerage firm. And this one agent will handle the facilitation of taking these assets and slowly but surely putting them online. Now, what I like working with these people, the reason I like working with them is because they will not list everything that they have in their inventory. So if you just call them on the phone and say, listen, I'm looking at this one property on 1234 Main Street. I'm not really interested in this one, but what else do you have? Do you have other assets you're working with that you haven't listed yet? And many times they'll tell you, well, yeah, there's a bunch of them that I have. I just haven't gotten around to listing them, or we're just holding them for now, or whatever the situation is. Usually they'll hold them because they don't want the market to be inundated with a bunch of foreclosures, because then that drives the price down. It's a very simple supply and demand economic equation, where if you have too much of one thing, then it becomes a lot less. So they will just kind of spoon feed all of these listings onto the MLS as time goes on. Now, after your first purchase, when you purchase with either a wholesaler or a listing agent or both, I'm telling you, you cannot beat these people off with a stick after this point. They're constantly emailing you, calling you all the time, saying, hey, I have this, or I just got that. But the cool thing is they will just start giving you these pocket listings where right before they're ready to list them to the general public, they will hit you up first and say, are you interested in this? And what's cool about this is that you have no competition. There's nobody else to kind of beat to the punch on it. It's just they just give you first dibs. You and a handful of other people that they know that buy properties from them. So in the very beginning, I recommend that you start off with a minor rehab or cosmetic property, a single family home ideally, if you're going to be doing a flip. I do not recommend a major rehab job unless you are a contractor or a handyman by trade and you know what you're doing. Otherwise, you're going to have to stick with minor cosmetic stuff, which includes, paint, carpeting, maybe replacing a sink here and there or something like that. And you don't want to be getting it down to the studs. We don't want to do that. We really want to work on the minor rehab stuff in the very beginning. Now, when you're dealing with either a wholesaler or a bank through the listing agent, you can negotiate as much as 50% off their asking price even. In the very beginning, I'd avoid auctions. Later on, as you get your feet wet in the business, you by all means can go to auctions and get an idea, especially when you've been working in a singular area for so long. You happen to know what a good deal is and what's not a good deal. You happen to know what the resale value of a property is and what's too high. So once you understand that, I don't recommend that you do the auction thing until later on, but you should do it later on once you get your feet wet in the business. And then there's fixer-uppers. These are what we call traditional sales. Many times you could drive through a neighborhood and find what's called FSBOs or for sale by owner signs there. And these are usually more negotiable because they're trying to sell their property and they want to save money by not dealing with a real estate agent. You could do a postcard campaign, as I just mentioned before. You could also hook up with a kick-ass listing agent for listed properties in that area and just let them know what you're looking for, which is older properties that need work that you can get below market value. And you're going to also be negotiating down on the price. You're going to be getting a home for, in the very least, 10 to 15% less than what they're asking is, and ideally 10 to 50% less than what market is. Ideally, 20 to 25% less than market value in that area. Short sales for me are the hardest to do. I don't like doing short sales. There's usually so much red tape with the bank that it just makes it completely not worth it. I don't know if you know what a short sale is, but say, for example, somebody has a $100,000 mortgage on their house, and the market drops so low that the house is only worth $85,000. So now there's an immediate $15,000 loss, and so you can negotiate with the bank to be able to get the property for that $15,000 or $85,000 or less, and then the homeowner has to eat the $15,000 usually on their tax report or tax return, and also too on their credit bureau reports. And so so the homeowner ultimately has to eat it one way or another. They're harder to do, but my biggest qualm with these is that they're more difficult to do because of the bank's red tape. I mean, you have to actually get the short sale approved. The owner has to get the short sale approved through the bank, and they have to basically approve that they're going to be getting less money on what's owed on the mortgage. So there are listing agents that do specialize in these types of properties. So if you're going to be doing this, I recommend you hook up with a listing agent who deals with these properties rather than trying to go it alone on that, because they're just so difficult to do in many cases. Regardless of which option you're going to be taking, you can use 100% of somebody else's cash to do these deals, including the rehab. So refer to your resource directory to get this money source, because the resource directory absolutely has the money source for you to be able to get 100% unsecured credit. Essentially, you'll be getting cash in 7 to 10 days. It would be wired into your bank account with no income verification, no employment verification, and no upfront fees, no application fees, and he'll just process your application out. But I strongly recommend that you at least A, know what area you're going to be flipping property in, and B, actually having a property picked out before you pick up the phone and call this money resource, just so that you can hit the ground running with it. But remember, whenever you're dealing with the end user, and by end user, I mean the single family homes or the single family properties, they want a property that's move-in ready. Now, I don't know if you recall, but in the last session, I told you that ideally you'll want to be specializing in creating turnkey investment properties for investors. And so as you move along in this, I want to see you eventually start getting duplexes, triplexes, quads, 5, 6, 7, 8 plexes, and that would fall under the commercial category, and up to 12 units, maybe even one day getting 20 and 24 units, to whereas you can ultimately go in there, rehab it, lease it up with tenants, and turn around and sell it at top dollar to an investor. Now, when you're dealing with single family residences, you're not going to get the tenant in there because the end user, the end buyer is going to want to move in, usually him or herself. Whenever you're dealing with a duplex, triplex, or quad, or anything a multifamily type of property, you're going to want to take that extra step of leasing it up, because the entire value of an investment property is in the income coming in from the tenants. And so if you have no tenants, then you're not going to be able to get the maximum amount of dollars on that type of property. So ultimately, you'll want to start finding duplexes, triplexes, quads, and then in the commercial category, 5 or more units for small apartment buildings, so that you can ultimately buy them at a discount, rehab them, lease them up, and then turn around and resell them using a really kick-ass listing agent, probably one you found in your adventures along the way, who can find an investor to ultimately buy the property for top dollar. Usually your investment property will go on to LoopNet or a multiple listing service site like that, so that you could ultimately sell your property to any investor across the country. And what I'm noticing lately is a lot of investors who are coming in from out of the country, like from places in China and so forth, but they're usually getting a lot larger properties. You'll be getting your dentist, doctor, lawyer, somebody who just wants a small turnkey investment that's already done and they're willing to pay top dollar for it. That's the ultimate moneymaker there, is to be able to flip those properties. So let me just tell you about a recent deal that I had done in the greater Detroit area, 2-bedroom, 1-bath. It was bought just over $13,000 as a foreclosed property. It required $2,000 in cosmetic upgrades, and it was really a cheap deal. We were able to get it under contract and sold to a new buyer in less than 30 days for $25,000, and the profit was $9,000 after all the fees. Block Street, which is a different street than Box Street, was a 3-bedroom, 1-bath, bought for just under $11,000 as a foreclosure, cosmetic upgrades for $4,000, and we were able to get it under contract with a new buyer in less than 45 days for $26,000. Our profit was just over $10,000. And that was just doing these little deals here and there that barely needed any money to fix up. It's very easy to do these. You can actually have 2, 3, 4 deals going at one time. Or maybe you just want to work as a finder where you're just finding these types of deals for investors or our own investment group, but you actually don't want to go forth and roll up your sleeves and try to facilitate the rehab yourself, which is completely understandable. But over time, though, this can become some serious cash, regardless of whether you're doing this as a professional finder or as a flipper, or you're doing both and you're doing multiple deals at one time. You can be making some serious money doing this, especially if you're working in an area that commands a higher dollar amount for homes. If you're working in a city that has a lower income area versus a higher income area, try to work in the middle or work with the border properties around the higher income area, because you'll be able to make a lot more money quicker when you're working in specific areas or cities that are known to have middle class or upper middle class people in there versus just the lower class places. The 2 illustrated deals I showed you, the one on Block and the one on Box Street, those were actually in lower income areas. It was almost like a lower middle class area, and that's why we're unable to make as much money. But then since then, that's when I first started out the single family flip business. We eventually moved into an area in the greater Detroit area called Livonia, and we made a ton of money in that area doing flips, because it tends to be middle to middle high income area in Livonia. So it makes a big difference when you switch up where you're investing, even if it's just a few blocks down the road, because you'll be able to make a lot more money. I mean, if you're going to be putting the effort into the building or the property, you may as well get maximum dollars for your time rather than getting minimum dollars for your time. And so that's all of this can add up to some serious cash, because you're doing hopefully multiple deals at one time as time goes on. And the coolest thing about all this, now this is the thing that I pride myself the most on, is that if you've ever been in the business of, I wouldn't say it's a business, I guess if you've ever been in the hobby of going from one guru seminar after another based on real estate investing, or if you've ever gone from one course to another when it comes to real estate investing, or even books on real estate investing, everybody will tell you how to do the business, but at the end of the day, they absolutely will not tell you how to get the money, which is the most important part. It's like you can understand how to do the flips until you're blue in the face, but I think most people, even a monkey, could probably figure out how to buy and resell a property. The problem is that you can understand the mechanics, but if you don't have the money to facilitate the mechanics of the deal, then you're just not going to be able to make money doing this. And so this has been the biggest obstacle for most people. One of my students, her name is Tori, you may have met her at one of my many seminars that I do. She told me about this one time where her sister dragged her to one of these guru seminars. I'm not going to tell you who it is, but he's one of those fix it, flip it guys that was on TV years ago, and he would fix and flip properties in Texas. And so he does all of these real estate seminars now, and she ended up paying somewhere between $15,000 and $25,000 for this bus tour / seminar deal to be able to meet this guy personally. And so he promised to tell everybody how to get money for their deals, how to get the money to be able to flip deals and so forth. So at the very, very end of the seminar, he tells everybody to stand up and he tells everybody to look at each other. And he says, everybody in this room has the money to be able to flip deals. All you have to do is reach out and talk to people and see who has a 401k, who has a retirement account, who has a savings account, and then call up people that you know on the phone and ask the same questions of family and friends. You know, do you have a 401k? Do you have any kind of retirement account? Do you have, any kind of savings? And that was his secret to finding money for your deals, was to ask everybody else, either those who were in the seminar venue or those that you have at home. That was the big secret. And talk about a letdown, spending that kind of money to go to one of these guru seminars just to be told that you just have to ask your friends and family for money. I mean, that's just, that to me, I don't think I could ever sleep at night. Now, the reason I pride myself so much is because I actually have a resource that can get you unsecured cash of $450,000, up to $450,000 to be able to do these kinds of deals, cash. And so all you need to do is go to the resource directory and that information is there for you. And so he works exclusively only for Monica Main students. He only works with us, and that is it. He even does mortgages. He does all kinds of different programs for loans to be able to pull off what we call the impossible deal. He can actually make possible for you. And so many of you may not start off as rehabbers. That's fine. That's cool, but please note that if you are in fact ever ready in the future to do that, then the money is there. I'm not going to ask you to ask your friends and family for their savings and their retirement accounts. I'm not going to ask you to bust in your own retirement account or your own 401k. I'm going to ask you just to pick up the phone or email my exclusive source to be able to get the money to help you do the acquisition and rehab of your property. So that's the cool thing about all this, and that's what I pride myself in the most is, first of all, number one, I don't consider myself a real estate guru by any stretch of the imagination, but number two, I actually do what I do. I do what I teach. I walk the walk. And I can actually help you get the money for your deals when need be. I'm not going to talk a big game and not tell you how to do it. I'm actually going to give you all the tools that you need to do it. So that might be a little down the road for you because you might start off as just a professional finder in the beginning, and that's cool. But again, to make the business of real estate work, you have to be able to utilize 100% of OPM or other people's money. And until you have that access, listen, all the millionaires and billionaires in the world, they all borrow money for real estate. They all do. They all borrow money for their business ventures. They all borrow money to be able to expand their businesses. And that's why the rich get richer and the poor get poorer. Well, there's a lot of reasons. One of the biggest ones for me is that the poor in the school systems, they don't teach you money management. They don't teach you entrepreneurship. They don't teach you investing in schools. So that's the biggest reasons why most people don't understand how to do any of this. Rich people that send their kids to schools, even if their schools don't teach it, they're certainly teaching it at home and how to do all this. So that's one of the reasons why the rich keep getting richer and the poor keep getting poorer. Another reason that the rich get richer is because of the way they think. They understand that all things are possible, and they know they can go out there and hustle, and money is endless, and abundance is everywhere, and they don't ever see limitation. A lot of poor people only see lack and limitation, which is why they can never get out of their own way, if you will. But one of the biggest reasons as to why the rich get richer is because they have access to other people's money and they know how to get it. And so that's why I started doing these types of programs to teach people how to access other people's money, starting years ago with a program that one of my best-selling programs. It's called Build Business Credit Fast. And in 2009, I came out with the program, and I've upgraded it a lot of times since with different resources and so forth. But I teach people how to use corporate credit to be able to gain access to endless amounts of money for their business and investing. And this is what the rich people do. They use other people's money using corporate credit that they build starting with their corporation, which is what I'm teaching you how to do in the very infancy stages here, having you get your first S corporation in your home state and then getting that EIN number, which is equivalent to your company's social security number, so that that company can start building credit for you. So then you can have endless amounts of money, because banks will give more money to corporations than they will ever give to an individual, because they understand that companies need money for inventory, they need money for payroll, they need money for a variety of other things for their business. So banks generally give businesses a lot more money than they will give somebody with perfect, pristine personal credit. That's just the fact of the matter. And so that's when I started teaching people these strategies on how to be able to tap into other people's money like rich people do, because these things are never taught anywhere else, period. They're never going to be taught in schools. It's never going to be taught anywhere else. Most other gurus don't even know this stuff to be able to teach people. So I pride myself in the fact that I teach people these things that you'll never find anywhere else. And so one of the other things is to, again, be able to access, having the exclusive source to access OPM or other people's money to allow you to do these deals. So how to find properties. Here's some ways to find properties. This is how you find SFRs or single family homes. It's through websites like homes.com, Trulia.com, Zillow.com. There's Redfin.com. There's auction websites, even though right now I don't really want you to participate in auctions, but you could certainly look and start getting an idea of what these platforms are like, so that ultimately one day when you want to do an auction, you know where to go and how to do it, or at least have an idea of how it works. You should hook up with a kick-ass foreclosure or REO real estate agent. You could usually find these people online by just simply looking at properties, connecting with people, picking up the phone. You ideally want to find someone who's a listing agent but can ultimately become your buyer's agent. Any listing agent can become your buyer's agent. But you want to find somebody you have a rapport with, somebody you get along with, somebody that answers your questions, somebody that's a pleasure to work with, somebody that will return your phone calls. These people are worth their weight in gold when you do find them. The cool thing about working with residential property versus commercial property is that residential property has all the cool real estate agents working under that umbrella. You'll have the most jovial, professional, joyous people to work with because they're salespeople. But when you get to the commercial side, all of a sudden there's just a major disconnect. They tend to be jerks, jerk-offs, a-holes is what you're going to be dealing with generally on the commercial side. But the good news is you're only going to be dealing with the residential side. Even if you're dealing with duplexes, triplexes, and quads, that's still considered multifamily residential property. And you're still, in most cases, dealing with your residential real estate agents. You're not going to be working directly with the loss mitigation department of a bank, which would be for single family properties that are foreclosed on. You're not going to be working with the asset management department of a bank, which would typically work with commercial properties that are foreclosed on, including small apartment buildings. You're not going to be picking up the phone and working directly with them. In some cases, if you happen to have an in with these people, like I have in years past, then you can make that connection. If you happen to know somebody because you play golf with them, or you somebody's sister-in-law or cousin works in the loss mitigation department of a small or medium-sized bank, then you can make that kind of connection. However, in most cases, you're not going to be picking up the phone and dealing with these people directly. All the facilitation of these deals are going to be through a liaison, which is typically a real estate agent of some kind that works directly with these banks to be able to help sell these properties. You could also pass around oversized postcards in older neighborhoods. That's, you could very well have one side that says, I want your property, even if it's a wreck. I'm looking for ugly houses. And then on the other side, you could talk about, if they're in trouble with foreclosure or in a short sale, that you want their property. So you could do like a double-sided postcard that has the information on both sides. You could do letter campaigns in older neighborhoods looking for fixer-uppers, but I don't recommend you do this right now because that's a very costly endeavor, and it's not worth it in the beginning. It's better just to pass around the oversized postcards in older neighborhoods for now. But you could do these letter campaigns at a later time. So for value, obviously you want to find properties that could be bought below market value. And the cool thing is that as our market starts to make these rapid changes across the country, these properties are going to come fast and furiously onto the market. You want to get fixer-uppers. Older properties don't want houses. You could find the comps in any area of the properties you want to flip, which ideally will be close to you in your own backyard. And the comparables is what the last properties in that area sold for. You ideally want to zero in on the cost per square foot on what the resale price was of properties within the last 30 to 60 days in that area, because it'll give you a really good idea on what to expect you could resell your flip for, or what the investor that you're looking at proposing the property to is going to be able to ultimately resell it for. So if you're a property finder, you still need to know how to do this, because your investor who is going to be paying you a bird dog fee or a referral fee for the property you find, he or she's going to want to know what the resale value is of that property to know whether or not the property is a good deal or good for a flip. And if you don't know, then the likelihood of that property being accepted and you being paid as a bird dog is going to be about 0%. So these are all things you're going to have to know regardless of whether you're a property flipper or a property finder. You will absolutely have to know what the comps are, what the properties are worth in that area, so that the investor knows whether he or she is getting a deal and whether it's worth their time to be able to go further with the deal that you presented. You never ever want to offer what asking price is. I mean, everybody in the business of real estate knows that if a property is listed at a certain amount, you're not going to be offering. With REO properties that are listed through a listing agent, that are put up by the bank, that are already foreclosed on, you can get them as low as 50% off, even in any phase in the market, whether it's a heating up phase, whether it's a cool down phase, you can get them for 50% off in most cases. Now, the cool thing about this is appraisals will not be required, so that's one step and one extra fee you don't have to pay for, but you do absolutely have to know your market. Now, you can go to my website, monicamain.com/CFE, and there's a CFE tab for SFR flips, which means that the tab will allow you to see how much you have to buy the property for, what you have to sell it for to be able to meet your goal profit amount, which includes the fees for buying and selling the property. You want your average flip to profit you about $10,000, otherwise it's really not worth your time and effort. And you want it to be a lot more if you're going to be doing a little more than cosmetic upgrades to the place. You want it to be, probably in the anywhere from the $20,000 to $50,000 minimum category if you have to roll up your sleeves and really do some work for that property. So a note about rehab. Again, do not choose properties in need of major rehab at the very beginning of your career doing this. Now, if you're just simply finding a property for an investor, then it doesn't matter how much rehab's needed, because that investor will put their crew into the property and it's not going to matter, about the rehab. But if you're going to be doing this as your own flip deal, then I do not recommend that you choose anything outside of minor rehab. However, if you're going to be doing this as a finder, you could find deals that are in need of great rehab, because many of the investors I work with have their own teams on the ground that could actually facilitate the rehab process. So remember, you want to be able to ultimately get your property sold within 30 days if you're flipping it. You could also use something called an ETF, which is it's an extended transactional funding source if for whatever reason you're unable to get the funding you need for your flip. My money guy is really good at getting people money 7 to 10 days. It's unsecured cash you can put into your bank account within 7 to 10 days. However, if you have a really, really low FICO score, like if you're in the 4s, 5s, and 600s, guess what? It's going to be very difficult for my guy to be able to pull off getting you $450,000 for your property flip. And so there's an alternative which you can use, extended transactional funding, which isn't a loan. It's just like kind of a wet loan, or wet funds as they call them. And it's for back-to-back flips. And so as long as you're able to sell them within 30 to 45 days, there's still some ETFs out there that can offer you these types of funds for these deals that you're working on. So for now, what I want you to focus in on, if you haven't already selected whether you're starting off as a property flipper or if you're starting off as a property scout, you absolutely have to figure that out this go around. You can't be waiting around to figure that out. We absolutely have to figure that out. How are you starting this business off? Are you actually going to be a flipper where you're flipping property, in which case you do have to flip property that's somewhat local to you? Or are you going to be a property finder, which the good news about that is that you can find property anywhere in the country, because I have an investor who will likely invest in the property that you're looking at, provided that it's in a major metropolitan area. So that's the good news about being a property flipper versus a property finder. You could also do both. That is an option for you. The next thing is I want you to get somewhat of an idea of where you'd like to invest and buy and hold passive income assets. Now remember, I told you, you don't have to figure this out today, but at least have it humming in the back of your mind. Where should I go to get buy and hold assets? And so if you'd like to go forth and do a little bit extra work just so that you have your eye firmly focused on the end goal, which is something I like to do as a person. I like to know the whole, I guess, shebang. I want to know the whole ball of wax right now, what I'm going to be doing. So if you want to go a step further, I recommend that you go to a website, loopnet.com, LOOPNET.com. That's a commercial website. You can get a free membership there. You go there and you start looking at commercial assets. And I think I went through this a little bit last time, where basically you just type in a city and state, as long as it has it's in a major metropolitan area of the country, as long as it has a population size of over 250,000 collectively in that area. Just simply type in the city and the state, and then you want the multifamily assets there. So you want to check the box that says multifamily, or you want to scroll down and pick the multifamily option. And you want to, number one, make sure that that area has a decent multifamily inventory. You want to make sure that the inventory is 20, 25, 30 properties or above in the multifamily category. The second thing you're looking at is to make sure that the average cap rate is over 8%. Now, not all of them are going to be 8%, but when you're looking down the profiles, the thumbnail profiles we call it, is your average cap rate 7, 8, 9%? Is you're going down 10% in some cases? Or is it like Seattle or Los Angeles or New York City, where all the cap rates are 2%, 3%, 4%? Because I could tell you immediately that you're not going to be able to make any area work that has a really low cap rate average. So that's the second thing you have to look at. So the first thing, again, is that we need to make sure that the first thing is that we're in, major metropolitan area of 250,000 or more people, which Google will tell you immediately whether it is or not. The second thing is that we need to make sure that there's inventory when we type it into LoopNet. Is there 20, 30, 40 multifamily listings in that area? And the third thing is the cap rate higher or lower on average? And that will help you determine whether or not you can find an area that you'd ultimately call your real estate empire area. The area that you're going to be building your real estate empire. It does not have to be anywhere near where you live. Could be 3,000 miles away. So please don't worry about that, but it does have to be in a singular area. I'd like you to start feeling that out, looking at possibilities. One of the other things that I tell people, and this is the unofficial thing, is to consider climate change. This is one of the reasons why I have a hard time seeing myself going back into investing in Florida. Even though Jacksonville, Florida is one of the really prominent areas when you want to get deals on properties, you want to have a higher cap rate, I would probably do that area if I were starting over in Florida, because I used to own tons of property in Florida, namely the Panhandle area. I had to end up getting rid of a lot of those properties when we were right in the 2009-2010 timeframe. There was a BP oil spill. I don't know if you remember that. That devastated a lot of the tourism there for a while, and it was just kind of a disaster for a little bit. And so I ended up getting rid of a lot of my properties. But ever since then, it's kind of been, on my things to do list to get back around to wanting to invest back in that area. It's just that I have my plate full with a bunch of other stuff that I'm doing in namely two areas of the country, Detroit and Atlanta, Georgia. But I don't want another area, I guess you could say. But if I were to start over in Florida, one of the first places I would look at is Jacksonville, because the cap rates tend to be relatively high. There's decent inventory there, and it certainly falls in tune with having a 250,000 or above in population size. So that would be a perfect area to invest. But the other thing you have to consider is climate change. Miami is going underwater. They have to spend billions of dollars on these pumps to be able to get the water out of the area. So essentially it's sinking, even though it really isn't technically sinking. I think the seas are just rising. So that would not be an area you'd want to invest in. Certain areas like the Keys, for example, I mean, they get beat up by hurricane after hurricane. That's not an area you want to be in. And even if you don't believe in climate change, so be it. But the cost to be able to have all this insurance on these properties for flood insurance and hurricane insurance is so extreme that it makes it completely not worthwhile to have property there because of these new insurance costs. So consider those things. There's certain areas of the country I absolutely would not invest anymore. Houston, Texas is one of them. New Orleans is another. Miami is certainly one. So areas that are mostly affected by climate change. There's certain areas in Middle America due to fracking and tornadoes that you wouldn't want to be in, like Kansas or Oklahoma or places like that. You might want to watch out for. So there's certain areas that you have to be really fine-tuned with the climate change, because you have to remember, once you get into this buy and hold asset business, you're going to be in it for at least 20 to 30 years, which means that with climate change as fast as it seems to be unfolding, you don't want to be caught holding the bag if you happen to invest in an area that all of a sudden there's category 5 and now category 6 and category 7 hurricanes blowing through once every 3 months. You don't want to be caught with your pants down like that. You don't want to put all the chips on, red number 9, and it doesn't turn out to be red number 9 at the end of your 20 to 30 year sprint on this. So you really do carefully have to consider these things when it comes to your 20 to 30 year plan. Another thing I'd like you to take a look at is where all the millennials are moving. A lot of them like to be in what I call little big cities, where it's affordable, they have a better paced life, but it's not New York, New York. It's not Los Angeles. So it's look at these little big cities, if you will, because that's where a lot of your millennials are going, but also too, that's where a lot of your Gen Xers are starting to shift to, because they want a little bit more of a peaceful life, not having to be running such a ragged pace in a place like New York City or LA or places like that. Especially since a lot of Gen Xers like myself, we know that we can make money anywhere as long as we have a computer and an internet connection and a U.S. Postal Service or a FedEx office someplace close by. So this is the trend. Another thing you need to take a look at is where all the Gen Xers and where all the millennials moving to, and it's going to be your little big cities. So take a look at those as well. That's another thing you want to look at, because that's where the money is going to be at in the next 20 to 30 years. I was just given I guess, kind of the shocking news that starting in 2020, the Gen Xers, my generation, is now going into the oldest Gen Xers are going to become seniors next year. And by seniors, I mean 55. And so I was a little shocked by that. I'm turning 45 this year. And so I was a little taken aback by that. So we're already going into senior land starting next year. But of course, we have a lot of years to go, and we have a huge amount of expendable income, unlike the millennial generation. But we have to now start shifting from how can we service the baby boomers to how could we start servicing the younger baby boomers and the Gen Xers. And so start thinking about where people are going to retire. Start thinking about, the areas in which people are wanting the best quality lifestyle, where they could still have a really good career, but they don't have to, live such a stressful life like they do in the big, big cities of the United States of America. So start thinking about stuff like that as well when you start focusing in on your end goal, the big prize, the bigger picture on becoming wealthy with passive income investments. All right, everybody, until next time, this is Monica Main signing off. I'll see you at the top.